It's no surprise that rich people know how to use the tax code to their advantage. I mean, Warren Buffett talks about how he pays a lower tax rate than his secretary, and Donald Trump openly talks about how he doesn't pay any taxes. As an attorney, I can tell you that there's a difference between tax avoiding and tax evading. Tax evading is illegal. You're doing a crime and you will go to jail. Tax avoiding is 100% legal. Now, you're using the IRS rulebook as a guideline on what you can do legally to not pay taxes. This is what rich people specialize in. They want to know what the IRS rulebook says, that way they can pay the least amount of taxes legally. The interesting thing is I never grew up learning about any of this. The first time I was exposed to any sort of financial education was when I read Rich Dad Poor Dad by Robert Kiyosaki, and not too long ago I was in Arizona talking with Robert Kiyosaki, and he told me that the reason why he's so rich is because he's in debt.
I save gold. I don't save dollars. I borrow dollars. That's why you want to listen to Dave Ramsey, who's a good friend of mine. Live debt free. I go, why are my friends all billionaires and they're deeply in debt? I don't even need real estate. I use debt. I'm just looking for an excuse for somebody to give me a loan.
Now, handling debt isn't for everybody. It requires a certain level of financial education, it increases your risk, and it requires some expertise in what you're doing. But what many rich people do who have mastered debt and taxes is they follow a system called BBD, which stands for buy, borrow, die. This system allows many rich people to now borrow money and live their life wealthy and pay $0 in taxes legally. So what I want to do today is go over how rich people use debt and taxes to their advantage to make themselves wealthier. That way you can potentially use this to your advantage as well, because the reality is this is how the system works and this is how the tax code works, and you can either learn it and use it or not. But here in this video, I'm going to go over how it all works, that way at least you understand. Wealthy people are not stretching themselves thin and going into debt so they can have a fancy car and wear Gucci and wear Louis Vuitton and go on fancy vacations. They go into debt for one reason and one reason only. It's for income. If it doesn't produce income, they're not going to go in debt to buy it. There are two general ways to do this. You can do this through business, or you can do this through real estate. A third way that sometimes people talk about is through investing their money, but when you invest your money, you're either investing your money in businesses or real estate to take advantage of the debt and tax laws. So I'm just going to focus on the business and real estate side and just understand that investing is incorporated into both of these. The way the tax code is made, it's designed to incentivize people that are producing jobs, producing homes, and producing things for the economy. But if you're just a W-2 employee and all you do is you make money and you spend it, it is going to be extremely difficult, actually impossible for you to take advantage of the system, because the tax code is not incentivizing you to really do anything. The tax code incentivizes you to invest and create and produce. It's not incentivizing you to just consume and spend and work. Now, that doesn't mean that you can't take advantage of anything that I'm going to talk about if you're an employee. That just means you're going to have to think a little bit bigger and do some things with your money outside of your job. That way you can take advantage of the system. And what you'll start to realize is if you don't understand the system, then you don't get any of the benefits. Like, one of the biggest benefits that people talk about when it comes to home ownership and tax breaks is if you own a home and you have a mortgage, you get a mortgage interest rate deduction, which is great for your taxes, and you get to take advantage of the system. But that's one big lie. Rich people and wealthy people don't care about the deduction because it's pennies compared to some of the other breaks that you can get if you understand how the system works. So let me start by talking here on the business side of things. The first thing that you have to understand is that you are taxed on your income. If you make a salary, if you make an income from your job or your business, you are going to be taxed on the income. If you work a job and you make $100,000, you're taxed on the $100,000. If you own a business and you pay yourself a $100,000 salary, you're going to be taxed on the $100,000 salary. But one of the things that you can do is not get paid through your business. So if you don't want to pay any taxes, then you don't want to have any income. Now, at first glance, you're going to say, if I have no income, then I have no money to eat. But that's not exactly correct. What some rich people are able to do is, instead of taking out an income, is they borrow against the value of their business. So let's assume that you build a business and it's worth $1 million. Well, instead of you taking out a salary of $100,000, you can go and take a loan against the value of your business for $100,000. Now, you still have $100,000 in your pocket, But this debt isn't taxable because you don't actually pay yourself anything. You're borrowing money from the bank, and now you have $100,000 in your pocket just like before, but this is tax-free because this is debt. Now, the thing that you have to remember is this $100,000 that you borrowed from the bank isn't your money. It's money that you're gonna have to give back to the bank plus interest. So if you have to pay this money back to the bank at, let's say, 6% interest, what you need to do is you gotta make sure that your business is growing by at least, what? At least 6% a year. Because if your business is growing by 6% or more a year, if your business is growing by 7% a year, then you came out a winner. So you didn't take an income. You don't have to pay any taxes on the $100,000. You borrow this money from the bank tax-free. And if you can grow the business by more than 6%, well, now you're a winner and you didn't have to pay any taxes. Elon Musk is probably the most popular example of this in action because he built Tesla. But while he was building Tesla for a number of years, he never paid himself a salary. So a lot of people were upset because he was worth billions and billions of dollars, but he paid $0 in taxes. The reason why he paid $0 in taxes was because he was paid not in dollars, but in stock options. So he never really got any money in the bank from his company. What he did was he got these stock options saying that he had the ability to buy Tesla shares for about $6 a share. It was something like $6 and some change, and he was given millions of shares. So when the stock price went up to $1,000 a share from $6 a share, he saw a lot of appreciation in the value of his stock options. And considering that he had millions and millions of stock options, he had stock options worth billions of dollars. Now again, this wasn't cash that he had in his personal checking account. This was the value of his investment, of his asset, his stock in Tesla. But instead of actually selling his stock and having this cash come into his bank account from the sale, that would be taxable. What he did was he went to the bank and he told them, hey, I have the stock worth $1 million. Just for example, give me a loan for $100,000. The banks were happy to do that because then the banks would make 6% interest, and now all Elon Musk has to do is make sure that his stock is growing faster than the interest that he's paying, because as long as he keeps doing that, he's coming out on top. He has cash in his pocket to live his life, and he doesn't have to pay a penny in taxes. Larry Ellison, the founder of Oracle, did the exact same thing. He had access to 250 million shares of Oracle, but if he sold those shares, he'd have a big taxable event. So instead of selling his shares and paying a whole bunch of money in taxes, he used the value of his shares to go to the bank and open up a $9.7 billion credit line. And now this is money that he can use to live his life. He's got to pay interest to the bank, but as long as the value of his company, his stock, is growing faster than the interest rate that he's paying, he's a winner. And then after that, they follow what I was talking about in the beginning of this video, which is BBD. Buy, borrow, die. What that means is you can keep doing this again and again and again, and as long as the value of your underlying asset, in this case the stock, the company, keeps growing, you can just do this until you die. Now you get to live your life, you get to have all of the nice things, and you never have to pay a penny in taxes. And then when you die, you pass your shares on to somebody else, and the person who gets your shares, your new company, they get something called stepped up basis, and they don't have to worry about the major tax implications because of the stepped up basis. What that means is, let's assume that you have a company worth $1 million, but your basis, what you bought it for, is $1,000. So in Elon Musk's case, remember, he was getting shares for $6 a share, and then when the Tesla company went up to $1,000 a share, if he sold his stock at $1,000, he would have to pay taxes on his profit, which is the difference between $1,000 and $6, which is $994 per share. So that's a lot of taxable income. So assuming here that you had a basis of $1,000 and now it went up to $1 million, you have almost $1 million in taxable income. So if you were to sell, you'd have a big tax bill. So one of the things that you can do is the buy, borrow, die. And now if you die, your heirs, let's assume it's your kids, get this $1 million asset. And then when they get this $1 million asset, they get stepped up basis. So the IRS assumes that they don't get it for $1,000. The IRS assumes that they bought it for $1 million. And so if your kids now sell this asset for $1 million, they have $0 in taxable income. If they sell it for $1.1 million, then their taxable income is $100,000. So you only have to pay taxes then on any gains above the $1 million, which is what the kids got. Now at this point, if you're thinking, Jaspreet, that's really cool if you were a billionaire like Elon Musk or Larry Ellison, but I don't have a $1 billion or a multi-million dollar business, so I can't take advantage of this. Well, there's some other things that you can do. If you have your own business or you're a side hustler, so now you're not a W-2 employee, you are a contractor, you have your own small business, well, what you have to remember is you only pay taxes on what's left. So you have your income that comes in, and then you pay your expenses, which are your deductions, and this is your taxable income. So what you have to understand is what can fall here into your taxable income. Because a lot of times people ask, is this thing deductible? Is it deductible for me to go on a particular trip? Is it deductible for me to buy a certain item? Well, a better question to ask is, how can it become deductible? Because almost anything can be a tax deduction if you know how to ask the right questions. This is where it pays, literally, to have a good accountant who's a tax advisor who can tell you what's going on and how you can use your money. That way you have less taxable income legally while you can still buy all the things that you want. So, for example, one of the things that's going on until the end of 2022 is the tax code is giving bigger tax breaks for business owners that are eating out at restaurants. So if you go out and you take your employees out to eat, you get a 100% tax break until the end of 2022 as a way to incentivize people going out to eat at restaurants, as a way to help stimulate the economy. So if you have people on your team, or if you are a side hustler, if you're a business owner, you have the opportunity now to get a tax break for eating out at a restaurant. We here at the Minority Mindset Companies went to a hybrid style work office after the pandemic hit, which means that people come in the office when they want. You can work from home whenever you want. But once a week, we do something called Team Day, where the team comes into the office, and every week in this Team Day, we go out to eat at a restaurant. Now, we didn't start doing this because of the tax break that we were going to get. We did this for fun, but it's kind of a nice bonus that 100% of the money that we're spending at the restaurant is a tax break on my taxes. Let me give you another example. If you're watching this video when it goes live, I will be on a 2-month business trip travel where I'll be staying in San Diego with my business partner, working on a whole bunch of different things. I'll be meeting with a bunch of different business owners out there, doing some interviews, meeting some influencers. So doing work out of San Diego, I'll be living in an Airbnb with my business partner. And I should also mention that my business partner is my wife. This is a tax deduction and it reduces my taxable income. Now, you might not be able to reduce 100% of every dollar that you spend, but if you have a good tax advisor, if you have a good tax accountant, they'll be able to help guide you and show you how you can spend money and have that money be a tax deduction. Now, the money has to be spent in a way that benefits your business, but if you are a true entrepreneur, a business owner, a side hustler, guess what? Your life a lot of times is your business. And so you have to understand how you can use this system to your advantage. That way you can legally pay less money in taxes. Because remember, the IRS is just a rule book. You want to make sure you understand how the rule book works, that way you can use it to your advantage. Now, what if you're completely not an entrepreneur? You hate the idea of starting your own business, you hate the idea of being a side hustler, you love the security of your job, and you can't leave that. You have to just work a job. And now what do you do to get some of these benefits? Now, obviously, one of the things that you can do is invest your money yourself, because when you invest your money, you get natural tax breaks, because investment income is a lower taxed income than your job income. But the second thing that you can do is through real estate. Let me show you one of the reasons why rich people love investing in real estate. So let's assume that you go out and you buy a property for $1 million, and this property generates cash flow of $70,000 a year. That means you buy this property for $1 million, then this property generates rent, because let's say it's an apartment complex, people pay rent. Now you have to pay all your expenses, you have to pay taxes, you have to pay insurance, you have to pay your management people, you have to pay your maintenance fees. After all those expenses, you are left with $70,000 in the bank. Now, chances are you probably don't have $1 million in your checking account to go and buy this property cash, so you'll have to go to the bank and get some debt to buy this property. Now, what you're doing is you're using debt to buy income. And in order to do that, you're gonna have to come to the closing table with some cash. So the bank might give you $800,000, and you'll have to bring about $200,000 to the closing table. Now, if you don't have all $200,000 yourself, this is where you'd have to go out and network with some people and go out and raise this $200,000. So you have $200,000 of equity, $800,000 of debt. Now, what happens is you're making $70,000 a year of profit, but you still have to pay your debt. So you'll have to pay about $52,000 in debt, which would leave you with $18,000 of net income after your debt payments. So now this $18,000 is left in the bank account after all of your expenses are paid, but you don't have to pay taxes on all $18,000 because you invested in real estate. Real estate offers some of the most favorable tax breaks that our tax code has to offer, because they offer something called the depreciation deduction, which says that every single year you get to depreciate the value of the building on your real estate. So let's assume that 20% of the cost, so $200,000, is the cost of the land of what you bought, and the other 80%, the $800,000, is for the actual building, the actual apartments on the property. Well, if it's an apartment complex, you get to deduct 1/39th of that amount, so 1/39th of $800,000 every single year over the next 39 years. That means you will get to take a deduction of right around $20,500 every year for 39 years, which means you have a loss of $2,500. Now, you gotta understand what this means. You have $18,000 in your bank account. This is money that you can spend. But you get to go around and tell the IRS, hey, I made $18,000, but I get to take this tax break, this tax deduction for $20,500. So you have a tax loss of $2,500, which means you owe $0 in taxes, because remember, you only pay taxes on income, and to the IRS, you have no income. Actually, you have a loss while you still have money in the bank to spend. But this is where things get even more interesting, because before, when you bought this property, you had a profit of $70,000. But now what a lot of real estate investors will do is they'll start doing some more renovations on the property. They're gonna work to improve the property, that way they can increase the amount of money that they're making. So maybe now you start adding in some stainless steel appliances. You update the kitchens, you update the bathrooms. That way now you can charge a little bit more money for your rent because you're providing more value for your tenants. And so now over the next few years, you're able to drive up your income from $70,000 a year to $100,000 a year. Now you can go back to the bank and say, hey, we drove up our profits. Before we were only making $70,000 a year, that's when we were worth $1 million, but now we are making $100,000 a year. Now the bank is gonna say, oh yeah, you've definitely increased the value of your property, so we don't think you're worth $1 million anymore. We think that your apartment complex is worth $1.5 million. So now what you get to do is you get to refinance against this property. So if we do the same thing and you pull out some cash, let's assume that you pull out 1.1 million. Now what you get to do is you take $800,000 from here, you pay off the old loan. You take $200,000 from here, you pay off all the investors. And that still leaves $100,000 that now you can put in your pocket for putting this deal together. And remember, this is tax-free because this is debt. This isn't income. So you get to pull out $100,000 for yourself, even if you didn't put in a single penny if you brought in other investors. But a lot of times you're gonna have to have some skin in the game. You're gonna have to put in some of your own cash. But this $100,000 now is yours. Now, of course, along with that, your debt payments are gonna go up as well. So now you're making $100,000 a year and your debt payments are gonna go up to around $72,000 a year, which still nets you $28,000 a year in positive cash flow after paying your debt. But now you own the property free and clear. You don't have any of your own money in the property. Your investors don't have any money in the property. It's just the bank's money. And so this profit is your return on your $0 invested in the property. You have no cash in the deal, but you're still making $28,000 a year. This is why it's called an infinite return. And you can keep doing this again and again and again as long as the value of the asset is strong. Now, it wouldn't be right for me to not talk about any of the risks, because one of the reasons why people get in so much trouble trying to do this is they either over leverage or they don't understand the asset. They don't know what they're doing, because at the end of the day, the value of you being able to do this depends on the value of your property, and the value of your property is going to depend on how much money you're making. So you need to know how to manage the property. You need to know how to get the property leased. You need to know how to give good value to your tenants, and you need to know how to keep generating these types of profits. If you don't know what you're doing, if you get greedy, you start over leveraging, well then you're the first one that's gonna get foreclosed on when property values go down and the bank wants their money. But this is one of the ways that real estate investors are able to leverage debt to pay no money in taxes while growing their wealth at the exact same time. This is why I said in the beginning of this video that one of the biggest lies that we're told is that the mortgage deduction that you get when you buy a home to live in is a big tax break for the average American. Now, what that really is not a tax break, it's a tax incentive. Because when you get a home, you buy $1 million home or a $500,000 home or a $100,000 home, and you get a mortgage on it, you're gonna have to pay money in interest. So assuming you pay $10,000 a year in interest to the bank, you still have to have an income to pay for that interest in order to get this tax incentive. Now, in order to get that income, you're gonna have to go out and do something else, versus if you are a real estate investor, remember what I said in the beginning, you're buying income. That's why wealthy people go into debt. They're going into debt to buy income from the asset, and the asset that you're buying is what's paying for your mortgage and putting some money in your pocket. It's cash flowing. When we're talking about your home, you have to have an income. You have to go to work every single day to pay off the mortgage to get this tax incentive, not even the tax break or the tax credit. You're getting a little tax deduction from the interest that you have to pay, but you still have to work to get the money to pay it, versus here, the assets doing all the work for you. Then it just goes back to the buy, borrow, die. You keep doing this again and again and again, and then you can do this until you die, and then when you die, you pass it on to your heirs, and then when your heirs get it, they get the stepped up basis, so they get a tax break when they go on to sell the asset. Now, I know all of this might seem really complicated. You don't have to go in and start buying $1 million deals right off of the bat. You don't have to go in and leverage yourself up to the eyeballs. There's a lot of ways to do this, and there's ways to do this without taking on a whole bunch of risk, just depending on what your risk tolerance is and what you're okay with and how fast you want to see your growth. But it all starts with your financial education, and it all starts with one deal. Like, I started my first real estate deal was a small 1,000 square foot condo, and it was a major headache because I had no idea what I was doing. But now real estate investing is a lot easier because I have the right people and I know what I'm doing, which makes the process so much more simpler and so much more passive. We're going to jump back into the video in just a second, but before we do, here are a few words from our sponsor, Fundrise. But before I give you this advertisement, I do have to give you a disclaimer, which is that I do have some of my own personal money invested in Fundrise, and I also own some equity in the Fundrise company as well. If you've been thinking about investing in real estate, but you don't want to deal with the headache of property ownership, Fundrise makes it easy for anybody to get exposure to real estate investments with as little as $10. And now you don't have to worry about going out and buying a property yourself. You don't have to worry about managing tenants, and you don't have to worry about unclogging toilets. The way it works is you invest your money into Fundrise and you're getting exposure to a portfolio of real estate properties. And then you will get paid your share of appreciation and cash flow if your fund makes money. Remember, this is investing at the end of the day. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will probably lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. The nice thing about Fundrise, though, is now you can passively invest your money into real estate without having to deal with all the headache of property ownership. Second, Fundrise has an auto invest feature. That way, if you want to continually invest more money into real estate, you can do that through Fundrise. And third, they have a very cool dashboard that you can use to track the progress of your investments. Now, the last thing that I want to remind you is that when you invest your money in Fundrise or real estate in general, your money is not as liquid as it is when you invest your money into the stock market. So you have to remember, if you're going to invest your money in real estate, whether it's to buy an individual property or to invest your money into a fund through Fundrise, you are investing your money for the long term because you're investing your money in real estate. So if you want to learn more and see how you can start investing with Fundrise, I got the link to how you can do that down in the description below. Minority Mindset is a paid partner with Fundrise, meaning if you use them, we will get compensated, but there's no additional cost to you. So if you want to learn more and see how you can start investing in real estate through Fundrise, I got the link to how you can do that down in the description below, where you can go to theminoritymindset.com/Fundrise. That's theminoritymindset.com/Fundrise. And with that, we'll go back to the show. When people talk about like loopholes that wealthy people use, are there like real loopholes that are only available to like certain people or real estate investors? Like what are those that people talk about?
The tax code is an extremely complex document, okay? The wealthy can afford to hire accountants and attorneys to look into these loopholes.
Okay.
They're considered loopholes in mainstream terms, but all they are ways where accountants and tax attorneys who've been paid to find ways to navigate the tax code. That's literally what it comes down to. Now, the wealthy understand the rules of the game. They play the game by the rules, okay? As they're avoiding the taxes, which is legal. Now, it's important to understand Netflix and many of these corporations who pay $0 in taxes. Do we really think they're stuffing cash under a mattress? No, they're following the law and they're following the tax code. The tax code is designed to incentivize those entrepreneurs because they're stimulating the economy, as I mentioned earlier, with jobs and housing. What it comes down to is this. Do you feel like you could spend your hard-earned dollars better than the government can? Most people would say yes, absolutely. The government even says, these are the rules of the game, follow these rules, and this is how you determine how much tax you want to pay. The wealthy have leverage because they have resources that they can use to find these loopholes, right? But if you're a business owner, you definitely have more leverage in determining how much tax you want to pay as opposed to an employee.
So like, for example, I know we're going into an election year. that's always when you hear about, the corporations, the wealthy corporations that don't pay their fair share in taxes. I know in the last election, I think Amazon was on the hot seat because Amazon's, trillion-dollar, multi-trillion-dollar company, and they make billions and billions of dollars and pay no money or have paid no money in taxes for a number of years. How then can a company like Amazon not pay taxes? Is that fair?
I'm an accountant, I'm a tax advisor. From my perspective, I think they're just playing the game better than many other individuals and entities. They're a conglomerate. They have unlimited resources. And when you have unlimited resources, not only can you hire the best accountants and tax professionals, but you're also can lobby for tax incentives, tax breaks. Now, something we have to remember is this. Everybody thinks if you're rich, you're evil. That's what they connect, right?
Yeah.
But let's look at what, and I'm not a spokesperson for any of these corporations. I have my own thoughts on that.
I know you got your own clients you're working with. Yeah, no, I get it.
So, but look at the amount of jobs that Amazon is generating. Look at the customer service. Look at the fact that we can order something off of our phone. You are directly paid based on how you impact individuals. So if they're making life more convenient for the consumer, maybe it's our fault for getting so used to having things done so instantly and same day, right? But from a tax perspective, they're investing heavily in real estate, in equipment, in research and development, in labor. They're making our lifestyles a little bit more enjoyable and more gratifying, right? We have that instant gratification. We're not waiting long for our packages to arrive or having to go to a box chain store. But what Amazon is doing is they're paying millions, if not billions of dollars in taxes. It's just not income tax or corporate tax. They're paying property taxes. They're paying payroll taxes. They're paying, maybe excise taxes between, importing and exporting. But it's just they're avoiding paying corporate taxes. So
Amazon creates jobs for hundreds of thousands of people. Now, when you as an employee work for Amazon, which is interesting now because this is more, I guess, the tax theory. As an employee, if I made $100,000 in Amazon, I'm not going to take home $100,000, right? Because the government's going to take the taxes first. Maybe I take 70,000, something around there, depending on where I live. But in addition to that, Amazon isn't going to pay out 100,000, right? Because they have to also pay payroll taxes to that person.
Correct. So Amazon is probably paying 110, 115,000. Plus, we have to think about benefits. So that employee is probably costing $150,000 because there's health insurance, there's life insurance, there's so many other benefits that they provide employees, and not just Amazon, but many entities to retain employees. Now, the payroll taxes that they pay, there's an employer portion and there's an employee portion. When you're receiving the net deposit annually of $70,000, the box 2, so the federal taxes that you pay, they're paying you your gross amount. They're just taking a portion of that and they're paying it to the federal government before you see it. And then when you file your taxes, you're either paid in full or you owe a little bit more money, which means not enough income was withheld. You can control how much of that federal income tax or state income tax that you pay. What you can't control is Social Security, Medicare taxes, because those are set rates by the government where the employee pays a portion and the employer matches that portion. So it does cost Amazon or other even small businesses more to have employees on payroll.
Yeah, that's interesting because I know even when I pay myself a salary, right? If I wanted to pay myself $100,000, I don't pay myself $100,000 to get $100,000. If I paid myself a salary of $100,000, out of my payroll, it's going to be $110,000, $115,000 that leaves my business account. But then I only hit $70,000 that might actually hit my actual personal account because now the business has to pay its employee. My business has to pay payroll taxes. Then Jaspreet Singh, as an employee, has to pay payroll taxes, so you're paying taxes twice. So somebody who is a business owner, you've probably seen that where you got to pay those taxes twice. Amazon as a corporation has to do the same thing. So you're saying that they're paying taxes. It's just the debate and the argument that a lot of people talk about is the corporate income taxes.
Correct. That's what they're not paying. And because they're investing so heavily in equipment, in real estate, they're able to, and even research and development, and there's even, I don't want to get too complex, but there's ways where you have your intangible assets that are offshore in a different country, and then this is what Apple does. They'll pay a royalty fee or a rent to the entity offshore to clear all of the profits that they're making.
Yeah.
So there are so many ways where these entities are just so much more creative because they have the resources. But as a business owner, as a small business owner, you don't have, or even as an employee, let's face it, we don't have unlimited resources that Amazon has. But we do have resources in our possession that we can tap into by just making the right decisions or working with the right advisors.
So let me ask you this now. So let's say, there's a big trend now of digital businesses, right? Like my Minority Mindset brand is a digital business. I could work in Detroit, I could work in California, I can work in Europe, India, it doesn't matter. So if somebody here is a creator or some sort of digital brand, e-commerce, you're on the internet, does it matter now where you incorporate your business? Like if you are a business in California, a high tax state versus, I don't know, Florida or Texas, a lower tax state, or even recently I was in Estonia and we were talking about this. I met with the ex-prime minister of Estonia. And one of the things he was telling me is that they're really trying to encourage digital businesses to move out to Tallinn in Estonia, which is a city in Estonia. And the reason why and the way that they're incentivizing people to do that, he was trying to pitch me to move one of my businesses out there. He was saying, look, we have this rule. Now, don't quote me on this. I don't know. This is just what he told me. I could be wrong. That essentially, if you make a business, create a business, you have it in Estonia, and your business makes a profit, and your money leaves or sits in that account, you don't pay any taxes. So you can make a profit. Because if in America, if I made $100,000 in profit and I don't spend that money, I'm paying taxes on the 100 grand. If he's saying that if I make the 100 grand in Estonia, right, I'm working around the world, but if my bank account's in Estonia or if my LLC or whatever entity is filed in Estonia, I don't pay any taxes. So now as a digital entrepreneur, can you play these games strategically like that?
It all depends on your residency. That's
Okay.
what it comes down to. So where do you live? Where do you sleep? Where do you spend the majority of your time? And I've found ways where even living in the US, people from California, New York, Michigan, they want that Florida residence. Why? Because there's no income tax in Florida. But the government would go as far as checking cell phone records to see what cell towers you're at to determine whether your residency is, if you truly are a resident of that state. So when it comes to the income tax that you pay, even though your entity is located in a foreign country, let's say Estonia, which has maybe more favorable tax law than the US, US tax code is based on global income. So it's one of the countries in the world where you're taxed as a citizen of the country on all worldwide income, whether you make it in foreign countries or not. Now, if you live in Estonia or you live in Dubai or other places around the world, you have a foreign tax income exemption, which means you could be a US citizen and make a little bit over $100,000 living in these foreign countries where your income up to 100,000, changes with inflation, is not taxed. So you're exempt on paying taxes up to that level.
Wow.
But anything above that level, you're going to have to pay tax as a U.S. citizen.
Interesting. That's, it's funny you said that about the cell phone towers because there's a whole thing going on right now. The IRS is trying to add, 40,000 or something agents. So you're saying that some of these agents are going to be looking at your cell phone records to see where you're living to literally, because their job is to make sure, the IRS wants to make sure that you pay your quote unquote fair share. You're saying your fair share is what you decide to be your fair share. The IRS, so I'm an attorney, right? Not your attorney, but I am an attorney. One of the things I studied was the tax law. Nowhere near to the extent that you have, and it went in one ear, out the other ear about now. But the tax law is complicated. IRS, it was like 2,000 pages long, the tax law. And what you're saying is you can strategically use rules to pay less money in taxes, and the IRS is just going to make sure that you use the rules. But that still means you can pay little to no money in taxes legally and still be completely free and clear, do nothing illegal, do nothing wrong, and the IRS can't do anything because you got the documentation.
You have the support. Now, there's a major difference when, unfortunately, I believe they're hiring like 80,000 agents, right?
Yeah.
Over a 10-year span, some of the current agents are retiring. I've worked with the IRS. I've had these face-to-face interactions.
How was that? You ever see the movie Wolf on Wall Street? Where they put them in a room and you just like put the AC on like full blast? Is it kind of like that?
There's two philosophies. Number one, you put the AC on blast, you're rude, you're not, yes, no, maybe, you're an attorney, what is it? Yes, no, I don't know, type of responses.
Right.
So, or the other philosophy is you're a human being. You treat them as a person because at the end of the day, they're citizens. The agents are citizens just like us. We choose that philosophy. Treat them kindly, speak with them, understand that we are relatable and we are working towards a common interest of the client, right? Now, we're willing to bet that because of our system that we've designed, that we have nothing to fear. Why? Because we have support for all of our deductions that we take. Now, if you don't have support, documentation, general ledgers, financial statements to support your deductions, of course you're going to be fearful. But for us, there is no fear because this is what we do for a living. And the system that we've designed is almost like an insurance policy for our clients as well because we're tracking all of the dollars coming in and all of the dollars coming out, not only for tax purposes to make sure that you only pay what you have to in taxes, but for banks, for investors, they go off of tax returns and financial statements when it comes to lending. You want to purchase a home, you're a business owner, they're going to ask for your pay stubs and they're going to ask for your financial statements.
Yeah, it's funny you said that because a lot of my friends that I grew up with are entrepreneurs to some extent. And there's some people that, I don't know what the right word is, but in the technical term, they're solopreneurs and like growing up, you call them hustlers, right? These are people that they're not dealing drugs, but they're doing things and making money, right? And their sole goal is to not pay any money in taxes. And the problem is then when these same guys that I know want to go out and buy a home is, oh shoot, I got no income, right? I paid no taxes, but now I have no reported income. I can't get a mortgage. And so this is where, you have to be smart and an advisor is really kind of there to guide you because I think these are really important questions because there are ways now you can pay less money in taxes as a paper deduction, but still have that income.
Exactly.
But then if you kind of go down, I'm just hustling, I'm making money, right? I'm DJing, I'm doing the photography, videography, I'm making money. And then you're making the money under the table or you're doing things which are illegal, which you would recommend do not do that, I would assume.
Of course, absolutely.
So do not do that. That's where now, you can pay no money in taxes, but you're also shooting yourself in the foot at the same time.
Exactly.
We're going to jump back into the show in just a minute, but first, here's an advertisement from our sponsor, me, with Briefs Media. If you're looking for an easy way to stay up to date on what's happening in the top finance and business news, we make it super easy for you to do that at Briefs Media because we created a free newsletter called Market Briefs. Market Briefs is a super simple and easy way for you to stay up to date on the top finance and business news. You can read Market Briefs in less than 5 minutes every morning. It's a fun and witty and easy to read newsletter, and I promise, if you join Market Briefs, you are going to love it. Now you might say, Jaspreet, how can you promise that I'm going to love Market Briefs? Well, if you don't love Market Briefs, you can unsubscribe at any time because it's completely free. So if you have not joined Market Briefs yet and you want to stay up to date on what's happening in the top finance and business news, I got the link to how you can join Market Briefs down in the description below, or you can go to briefs.co/market. That's briefs.co/market. And with that, let's go back to the show.
Here's how the whole system's designed. In America, there's credit and there's taxes. As long as you have,
I like that.
As long as you have good credit,
Yeah.
and you're profitable on paper through your taxes, you can have unlimited resources for lending. Okay, because we are a consumer-driven economy. The banks want, we want you to spend. We want you to buy homes. We want you to create businesses, and investors and the banks and institutions, even the government, will work with you to help you achieve that goal as long as you have good credit and good sources of income. Now, there are many individuals who feel like they're hustling the system or I'm getting refunds each year. You don't want to get a refund. You actually want to break even because then you're just giving an interest-free loan to the government, or owe a little bit of money in taxes, because if you owe money in taxes, it's a good sign you're making money. But strategically, you can receive refunds or not owe any money in taxes to the government on paper. So for example, you're a mortgage officer. Every time we release our tax returns on behalf of our clients or their financial statements, because remember, you're a business owner. The corporate world, your boss, your manager, the president of the company is no longer going to hold your hand and pay the taxes on your behalf. It's your responsibility now. You're the employer and the employee as a business owner. So you have to determine your payroll, how much tax you're going to pay, what your salary is going to be. And you also have to have a system in place that tracks all of your income and expenses in order to file your taxes properly. A lot of mistakes that entrepreneurs make is their financial statements don't match their tax returns. So when an opportunity arises, like your friend who wanted to get a mortgage, if the financial statements and the tax returns don't reflect each other, there's a huge discrepancy. And knowing that they were self-prepared and they weren't, it wasn't a third party or an outsourced firm who was preparing these documents, they're less likely to treat these as the more eligible qualifications for you to qualify for the mortgage. Now, from our perspective, it's important that you take advantage of the tax code by only paying what you have to in taxes. Depreciation is something that the banks add back. So for example, let's say you had $100,000 in profit for your business, but you had a $100,000 deduction in depreciation. Your taxes show zero income. But if you provide that tax return and that financial statement to lenders, the mortgage officers and the banks know that they can add back depreciation to qualify you for financing. So it's the best of both worlds. You saved on income tax, but you also qualified for financing because of that designation, where that's just what they do. They understand that you're not out of pocket. You were just able to tap into that code of the tax code in order to tap into that deduction. So there are many ways strategically where you don't necessarily have to make hundreds of thousands or millions of dollars to qualify for lending. But at the same time, you don't want to play the system where you're showing $20,000, $30,000 or if anything at all through taxes and expect that you're going to grow in this country. You're simply not. You're not going to qualify for anything. You may qualify for benefits from the government, but at the end of the day, that's going to keep you at bay. That's not going to allow you to grow. So
no, I that makes a lot of sense, and I agree. One of the things I know working with you is my whole goal is, look, I like to play it safe, right? Because my big thing is I would rather not deal with the crap than pay a little bit extra and do things right. And that's where I like working with someone like you, where you're like, you know what, we know what we're doing, just let us kind of guide you. But one of the things you were saying earlier, which I kind of want to bring back to you, one of the things you mentioned was ordinary and necessary deductions. And the second thing you said was lifestyle expenses. And the reason why I want to talk about these two is because there's a lot of influencers growing, right? A lot of people want to be influencers, content creators to some extent, whether you are a professional, whether an entity, or whether you're just starting off. How can now somebody as a content creator, fully established, making millions or making no money at all, start using the tax code to their advantage with these types of deductions?
As a content creator, you're a creator, you're creative, right? Accounting is a foreign language, let's face it. My experience comes from working with CPAs who've been doing this for 30 plus years, right? I started this business 10 years ago before even hopping into the social media realm. And correct, there are there's a lot of content out there in regards to, it's almost like that paralysis you get where there's just so much information coming at you, you don't even know where to start. What it truly comes down to is being able to relate to your content, that I'm going to hire this individual or this team or this group, and they're going to look after my best interest. Your accountant must care. And too many times I've seen it in my career where it's not my money. I'm not the one paying taxes. This is what you owe. You're making money, just pay the bill. That doesn't sit well with me. And I experienced that.
Me neither.
Right? And it takes two to tango, and it's a two-way street working with us. But as an entrepreneur myself, this is how we operate our business. Like we don't need to have an office this way or, but this is we're business owners at the end of the day. So we treat every one of our clients' business as if it's ours. So there has to be that personal connection. So as a content creator or even as a business owner, if you can relate to your accountant on a human level, where you feel like this person cares about my interest and is going to look after my interest and is not going to compromise me, then that's the right person that you need to work with. Now, as a content creator, when you are, your lifestyle is your business. Let's face it. You're recording content 24/7. You're documenting your lifestyle. You could be working from home. You could be traveling or you went to Europe or Estonia. That's all deductible. Why? You're not going to Estonia for personal reasons. You're going there because you were invited to speak with other entrepreneurs at a conference. So your airfare, your lodging, a portion of your meals, this is all 100% deductible.
But while I was there, I was also sightseeing.
Excellent.
They took me out to dinner. I saw some cool places. We ate at some beautiful restaurants. We also saw Germany on the way. What then qualifies? Like, so where is that cutoff now from being a tax deduction versus not? And then what about me going out and buying Starbucks because I show up at Starbucks?
That's a great point. That's an excellent point. Where do you draw the line? Something you mentioned was you feel confident knowing that we are able to make those decisions on your behalf. Consulting and having that open communication, that open channel is extremely important. But we're conservative as well, which means we're not afraid to take the deductions as long as we have the support, but at the same time, we're not reckless. We're not going to compromise any of our clients. Now, we always back out a personal portion of these expenses. So for example, your vehicle expenses. We're always going to take out 20, 25% and say, hey, this is personal. This is not business. This was not logged as business mileage. Your trip to Estonia, that when you stopped in Germany, that's a personal portion. We're not going to take that as a business deduction. So we can't say 100% of your trip was business purposes. That maybe the airfare was because you were going there for business, but while you're there, the meals, at the end of the day, we're humans. We have to eat, drink, sleep. Okay? Is it ordinary and necessary for you to sleep in a 5-star, 7-star hotel? Probably not, right?
What if I'm recording videos in the hotel?
But to be more preventive, we want to make sure that we're going to say, all right, I'm going to take 80% of this as a deduction. I'm going to be fair. I'm going to protect myself, like insurance, like we mentioned earlier in the conversation. I'm not going to say 100% of this was documented. And I've been through these audits. We've had clients who have G-Wagons, private jets, assets that are luxury assets. And, you see it on social media. You can write off 100% of a G-Wagon. Yes, the gross vehicle weight qualifies to be written off 100%. But if you're driving that G-Wagon home, or if you're going to your kids' practice, or you're going out on a date with your spouse, that doesn't qualify as a business deduction. So it's just important to be a little bit generous when it comes to the government as well, to say, all right, government, I'm going to take 80% of this as a deduction, and I'm going to show you, look, I've backed out 20%. And I'm speaking this from experience. I actually showed the agent. I said, look, this was the personal portion that we backed out from meals. This is the personal portion that we backed out from vehicles, the lifestyle deductions. This is what we backed out from travel. This is what we backed out from uniforms, because you're in a very fine suit today, but you can't necessarily write this off because you can wear this to weddings, dinners, private events as well, unless you had your logo on it. But that's a different subject. Now, being cautious of your deductions and making sure that I'm protecting myself between the business use percentage and the personal use percentage is just a way of protecting you.
And so pretty much what you're saying is if you spend $1,000 on something, travel, meals, whatever, you're saying that instead of taking a full $1,000 deduction, you take $800. That way it's a $200 is for personal. But now as a creator, right, let's say I'm recording out of my house. It is your life, right? I'm going to be, like, if you're a vlogger, you're vlogging your life.
Correct.
So, like, the stools and chairs in my house, the dining table in my house, the food that I eat in my house, like, where do you now, like, is everything a deduction?
It's an excellent point. And I'm, as an accountant advisor to many creators with millions of followers, I get it. I understand it. This is new. This is new to the IRS. They're not used to this. Just like, crypto is a little bit is new. But at the end of the day, it's ordinary and necessary. And I remember the words of the agent. Is it necessary for this client to drive a G-Wagon? I said, yes. She deals with high-end clients, celebrities. This is part of her brand. And she looked at me and she smiled. She moved on to the next subject. Like I said, it's all about the human relationship. They see that you're doing a good job, you're providing documentation, you're providing support. At the end of the day, it's the story. Can you support your deductions? Do you have the story to support it? As a content creator, yes, you're vlogging from home. But at the end of the day, you need a home to live in. So my advice to you would be, you can't take 100%. That's setting yourself up for failure.
So you're talking about the mortgage now, deducting the entire mortgage.
Yeah, you can't. You could take a portion of your home office. Now, your home office, you could take the standard rate of it's a simplified method rate based on the square footage of your office in comparison to your home. Or you could take the actual expense method, which means you could take a portion of your mortgage, your utilities, your repairs, your construction, part of your interest as a deduction, but it's subject to the square footage of your home. We have clients that say, oh, well, I use my whole house as an office.
I was going to say that.
Technically, that doesn't qualify per the IRS rate rules. But there are many ways, Jaspreet, of avoiding, not evading, but avoiding those rules, where there's the Augusta Rule. You can write off 14 payments that you make to your home if you host events or functions, team building activities at your home. So let's say it would cost you, Jaspreet, $2,000, $3,000, $5,000 to rent an event space to host some of your employees in your team for a team building activity. Strategically, you can take, let's call it $2,000 a month. You can do this up to 14 times. Let's call it $24,000, okay? We can call it $28,000. You could transfer that amount every single month, 14 times, to your personal bank account, and it would be considered a rent expense or an event space expense. Now, you could claim that income personally because you've received the deposit, and you would not have to claim it as income because it's called the Augusta Rule. This is based on the Augusta, the golf tournament in Augusta, Georgia, where individuals were renting out their home to the golfers or to spectators, fans who were watching, who would travel to Augusta, Georgia to watch the tournament. And they were out of their home for, let's say, 14 days. They were able to not claim any of that income as actual income. So you as a business owner, you want to use your house, you want to write off your mortgage, there are ways of doing that without writing off the mortgage payment you make to Chase Bank. It's, I'm going to transfer and I'm going to actually have a document, an event space lease document between myself, Jaspreet Singh, and my business that I'm going to pay $2,000 a month because I'm hosting my employees, my team at my house for a team building event. And you just wrote off $24,000 to $28,000 tax free.
You know, it's interesting that you say that because over the pandemic, I think a lot of ways business has been done has been changed. And I'm not going to say who out of their privacy, but I've done a lot of really cool podcasts and interviews over the years. And more post-pandemic, these podcasts have moved into the influencers' homes. Now, some of these homes are tens of millions of dollars. And so what these influencers have done is they take a portion of their home, their living room, certain rooms, or they build something, and they'll turn that into like a studio, a recording studio, but they'll also bring their team to come work in their home every day. So now you're buying these beautiful homes, but they become now or more of it's becoming an office. And it really is. I mean, they have the studio that's literally like a recording room. You have an office for employees to come in and work. So I guess like just talking about the potential, if you have a business, you know, how you could use that. But even like going back to what we were talking about before, let's say you're making $75,000 a year and you are getting into the cupcake business or whatever it might be, you need an office to, you know, take the phone calls, manage your orders. So you can now also write off a piece of your home, potentially.
The pandemic changed the game, changed everything. It's a leveled playing field now. where the home office was heavily scrutinized. And pre-2020, pre-pandemic, it was one of the most heavily audited items, absolutely, because everybody would just take advantage. There used to be something called URBIs, unreimbursed employee expenses, right? Where corporations, you were able to deduct your mileage, you were able to deduct your home office, even while you were working for an entity. But that changed in 2018. So a lot of employees that were working from home weren't able to offset that as an itemized deduction.
Wow.
So that's no longer available. Now, the pandemic changed that because, and unfortunately, even if you're an employee, you still can't write off your home. So writing off your home only qualifies for business owners and entrepreneurs, period. Employees can no longer write off their home as an itemized deduction, okay? Now, back to your content creator friends that are investing heavily in their primary residence that they've converted into podcasting studios or for their business. Look at it from this perspective. If I, as a, at that level, as a content creator, want to purchase a $10 million home, if I want to purchase a $10 million commercial space, and I know the world has changed, I could spend $10 million on a home and a commercial space in one, and I can get the benefit of both. Now, it would be more flexible for you to work from home. You get the benefit of the primary residence, the income tax exclusion on $250,000 to $500,000 in profit, tax-free. But remember, even if you do work from home, what I would suggest is creating a rental agreement with yourself. So your entity would pay rent to you personally or to your LLC of the space per month. It's a legal document. So that way, if God forbid you were to ever get audited, you can present that document to say, hey, I have a rental agreement with myself or with my other entity for this space of my home. Now, yes, you could tap into the electrical, the utilities. You have the backyard, pool. It's a great space for your team, your activities, your hosting guests. It makes you almost want to invest in that. But at the same time, remember, you're depreciating these expenses. So you'll have ordinary expenses, your rents, your insurance, your utilities that you can write off. But it's important that you take that percentage of your designated space and tap into those deductions only. Or you tap into a general rental agreement that you have. But remember, if you're paying rent from your business, you're collecting rent to yourself. That's income. So one way I like to avoid that overall, so you're avoiding depreciation recapture, you're avoiding having to claim that rental income, is the Augusta Rule. It's the best of all because you don't have to claim the income. You can say, well, in order for me to have this podcast that I have once a month in a studio, it's going to cost me this much, fair market value. You're able to charge that rate for yourself through your company and not have to claim that as income on the personal side. Because remember, if you're paying rent to yourself, you would have to claim that on Schedule E, which is the rental income and expenses for real estate that you would report on your personal 1040. So there are many complexities in it. If you sell the asset, you're going to have to recapture depreciation anyway. So I feel like the cleanest way of doing it is tapping into the Augusta Rule. 14 payments.
Interesting. So what's interesting to me is the complexity of how deep things can go. Because I think, if for somebody, if you're making $75,000 a year, I'm going to keep coming back to this example, you might be very overwhelmed. Like, Augusta Rule, this, that, depreciation of this, depreciation recapture of that, itemizing these. When practically, at that point, it's not a big nominal amount, right? Like all these things, maybe at the end of the day, just a standard deduction might get you better than doing all these things and spending all that money. Versus now, when you're talking about $250,000 or $2.5 million, now there start to be more reason to look. I mean, the complexity of things, or 25 million, now it becomes more ammunition to look for these things. So like if you're making $75,000 a year, you got a job, but now you're starting your side hustle, I guess when is it worthwhile to consider like the standard deduction versus the, I'm going to spend my time to do this or hire an accountant to reduce my tax liability to zero?
All of our clients are business owners. We don't work with individuals just to file their taxes. Our niche is just working with business owners. But we do have some high net worth individuals who are executives of companies who are clients of ours. Even if you are a Fortune 500 CEO, at some point in your life, you're going to want to create a business. There's a Chinese proverb that says the best time to plant a tree was 20 years ago, and the second best time is now. If you are an employee, even if you're making $75,000, start your business, start your idea. I know there's a ton of information coming at you. Everybody's trying to grab your attention. But if you can start a business by just simply doing something e-commerce or something hobby related, you are able to, that's the first step. Go after that idea. Create a business plan. Just put your ideas on paper. It could be a one-page business plan. Pursue that passion of yours and try to monetize it. And ways where you can monetize anything that you can, any business that you can create to benefit others will be profitable. Guaranteed. If you are in service of helping others, you're going to make money. Now, starting that at $75,000 is extremely beneficial, where it's just, look, I have one W-2, I work for this employer, I enjoy my job, I like who I work with, I'm happy. Sometimes it's not about how much money you make. At the end of the day, are you happy? Do you have less stress? Is this something that you are passionate about, going to work every day? But at the same time, forget real estate for now, because you have to be at a certain level to be able to invest. You have to have the down payments, you have to have good credit, history of income. Start with that side hustle, that Schedule C. Pursue that cupcake business and say, you know what? My goal is to generate $1,000 in revenue. And my expenses are going to cost me $100. You just made $900 in income. Slowly but steadily start building that business enough to the point where you're like, wow, I really enjoy this. I feel like I'm working on a business that I'm making money with, I'm helping others, and I may get to a point where I can leave my job and just navigate into the business world. Entrepreneurship is the final destination. There's also entrepreneurship. So you may work with a company that you feel like is growing. The founder has a great vision. I want to be part of this company. I don't necessarily want the responsibilities. I don't want the stress. I don't want the headaches, but I believe in this cause. I believe in this mission. That's, you want to align yourself with visionaries that way for you to grow and succeed.
Tell me about your firm. You built the CommonWealth Group. I know it personally. How did you do this? I mean, you were an entrepreneur yourself. A lot of accountants, CPAs are not. What made you want to study accounting, because that's tough in itself, but then want to go out and build this firm and then build the firm to this point where, you said you run it for 10 years, which already in that 10 years, you've worked with very successful and only high net worth individuals to make such an exclusive clientele. People who are, like you said, flying private jets are coming to you. How did you build that type of firm?
So I started the firm when I was 23 years old. Okay?
23?
23 years old. I went the pre-med route, similar to your story, right? And then I took a biology class and organic chemistry, and I realized, man, this is just not interesting.
Yeah.
And, prerequisites weed people out. Yeah. And it actually worked for me. I took a business law class. Now, I worked at my uncle's clothing store in Northville, Michigan. It's a custom clothing store. His clients are top 1.5% of the country. We're talking about executives, coaches, CEOs, sport franchise owners. So it was incredible for me to be able to experience what the relationship was with high net worth individuals at the tender age of 17, 18 years old. So after graduating high school, I would work at the shop, and I called it Alexander's University because it was real life experience. And in meeting with these high net worth individuals, it was a unique experience for me because I saw what was on the other side. I was able to sell $5,000 suits to executives at such a young age, and I understood the intricate details of fine clothing and custom suits, and understanding that this is not about sales at the end of the day, and even for our business. And I took those lessons where we are entrepreneurs first who happen to be great accountants. Our mission, I said, if I was going to create a business, being that all of the income, all the revenue that was generated at my uncle's store was not spent by physicians, some were, but a lot of them were entrepreneurs. Some of them were people who didn't even graduate college. They were in the trades, they created a product, and these guys were ultra wealthy. And I remember someone in the city actually donated $1 million anonymously. And this person had like, private jet, helicopter pad, and that inspired me. So I said, you know what? I'm going to tap into the business field. I understood that accounting and finance were the top 2 degrees to have. So I switched from the pre-med route to the accounting and finance route. I went to the University of Michigan. I gained my 150 hours in both accounting and finance. And I said from the beginning, my intention is not to go the public accounting route. I knew partners at PwC, Ernst & Young, Deloitte, Plant Moran. I still know them to this day. And I could have always went that route. But for me, my intention, even in Accounting 101, was we're going to create a firm that's going to deal with high net worth individuals, the fabric of America, the small business owner. And we're going to provide them an unmatched experience that's on a human level. Not an accountant, pocket protector, unhealthy, overweight, always giving bad news. I wanted to bring a sense of life, youthfulness, and energy into this industry. So after graduating, I said, all right, I'm done. I'm going to start my own accounting practice. And just like many entrepreneur success stories, I received a phone call. It was from a family friend who called me and he goes, Khalil, I'm having this problem with my businesses. I feel like I'm overpaying in taxes. Something is not right. And he's like, do you know somebody that can come into my office, figure out what the hell's going on? Yeah. And I said, Steve, I got the perfect guy for you. He goes, who? I go, me. And he's like, oh my God, did you graduate college? Are you done? Are you ready? Do you understand this industry? I know everything about your industry. I knew whenever there's an opportunity, you have to take it. You miss 100% of the shots you don't take. So I told him, I'll meet you on Monday. I went into his office. I had this proposal. I said, this is what you're going to pay me. And to his credit, he agreed. And he gave me that opportunity. And honestly, that's all I needed to show myself who I was and what I was capable of. But more importantly, show the client that this was the best decision he made. So after requesting documents, I ended up requesting about 2-3 years worth of sales tax information. And at the tender age of 23, 24 years old, I found that he was overpaying $50,000 in sales tax. Wow. And his CPA at the time he's a mentor of mine, a great individual. I called their office and I said, hey guys, I'm working with a mutual client and I found this discrepancy, and they hung up in my face. So I was like, maybe the phone disconnected. I always give the benefit of the doubt. I called back and they were being so rude to me. And this is something I'd never forget. They were so rude to me because they felt like I was attacking them, that they made this mistake. But that wasn't my intention at all. It was more like, hey, all right, let's put this behind us. We're all human. Let's recover the funds and have our mutual client receive his hard-earned money back. So long story short, the CPA calls me back. He says, Khalil, great job. This is accurate. Our client received a $55,000 check with interest because it was over a few years. And he offered me $5,000 out of that check. And I turned it down. And I said, I'm not taking a dollar from this because this is what you hired me for. This is what you paid me for. I would set up shop internally. And that meant I wasn't able to open up an office space yet because I was just starting off. When I did that, it showed him that I was a man of integrity. The reputation was extremely important to me. I'm a man of my word, and the results are what I'm after. It's not about the money. The money will always follow. So starting that way, we would grow little by little, all through word of mouth. We never purchased a book of business. It was all organically, all based on referrals. And the highest compliment that you can receive is when somebody refers a family member or a friend to work with you. Then I realized there's a massive void in this industry. That CPA ended up offering me a job. He paid my company. I would work tax seasons with him. Remember, he had 30 years of experience. So he threw everything at me. So I was working on farm tax returns, estates, things that a 24-year-old would never come across. And I know many CPAs who have never come across that in their career, let alone so early on in the game. What that did was it allowed me to take the good, leave the bad from my mentor. But I always said, I'm going to create a practice that's entrepreneurial driven, that is success driven. That is when a client rolls up in a red Ferrari to our office and says, hey, I used to hide this car from my previous accountant because I didn't trust him. Yeah. That's the ultimate relationships that we seek. And being able to tap into social media and then start developing the brand organically. Remember, I only got into the social media world a year or two ago, right? I was behind the scenes working at this office, like you see here, on real life files and accounts and building personal relationships. And then I decided there's a massive void in the market. And if we can help many businesses across the country with their accounting and taxes and teach them about financial literacy and financial freedom, just like you do on the personal side, we're going to do it through the tax side. This creates more prosperity with individuals, with their families, with their communities, to determine how much tax they want to pay. They keep those savings. They invest them in their employees, their business, their communities. They can do whatever they want with it. Because let's face it, the government is spending our hard-earned money extremely poorly. And if we can control and stretch that dollar, we can do it a lot farther. We can do a lot farther than they can. And from my perspective, that's what motivates me. The fact that we are an intermediary. We want to work with the government, but we are also looking out for our clients' interests first and foremost. That's the journey of how we got here. And then we crossed our own paths. I don't know if you...
Yeah, that's a funny story because I was working with a different accountant at the time. Actually, no, we crossed paths before then. And you were very nice. You're like, if you ever need anything, here's my number. Never hesitate to call me. Even if you just want some advice, just call me. I said, okay. I don't think we talked for maybe a year or two. And I always had this kind of like rough relationship with my previous accountant. And the turning point when I called you was I got a call. This was like, I think it was January. My accountant calls me and says, Jaspreet, we screwed up. You got to send in $100,000 by the end of the day to the IRS and like $15,000 to the state of Michigan. I was like, what the heck are you talking about? He's like, oh, by the way, you're also going to have to pay a penalty on this. Naturally, I was a little frustrated. Hung up that phone. I started pacing around my office. I was like, this is so stupid, right? Like, this is so dumb. Like, you have other plans of like where you're going to be investing the money. And that was really the turning point where I was like, I need to find something else. And then I remembered our interaction. And I was like, let me call Khalil. I don't remember where I kept your number, but I had it somewhere saved. And I called you and you picked up. I said, what's going on, Jaspreet? I was like, what's going on, man? Hey, dude, I got a story to tell you. You were like, what's that? And I told you what happened. And you were like, I'm coming to your office next week or tomorrow or something. It was like within the next week, you were like, let me come to the office. Let's talk about this. We went through the numbers and you were like, he's like, you can make a lot of improvements here. And I was like, really? He's like, yeah. He said, let me put together a proposal for you and let's do something. And from there, that was now like somebody who's watching this might have heard me say, if all your tax advisor or your accountant is doing is filing your taxes, you are leaving a lot of money on the table. And that was when I realized, because the approach you took was so different, where your job wasn't to go in and file my taxes. Your job was, now you're looking at the financials, giving me the regular reporting, but then also advising me, saying, you can do this, you can do this, you can do this. This is what your tax liabilities, let's try this. This is a new deduction that was created. You want to take advantage of this? The power is me to do what I would want to do, but you're giving me the guidance. And that, I think, is the big difference. And that's why I asked you, like, yo, can we build a partnership? And which is why anybody who's watching this video, if you want to get a free consultation with Khalil, if your business qualifies, all you got to do is click the form down in the description below. But that's the whole idea. I was so surprised when I started working with you that I was like, there's such a need. Because I've worked with a lot of accountants before. And that was the big turning point. And it's number one is you got to be knowledgeable, which anybody can be knowledgeable. But then it's how do you apply it and actually look out for the client's best interest and actually provide that care. So that, it's very valuable. And it was interesting hearing your story because I actually didn't know your entire journey of how you built it. But a beautiful man, beautiful suit.
Thank you.
Thank you for coming on.
Appreciate it.
Where can somebody learn more about you, follow you, see what you're doing, and just learn more?
I appreciate the opportunity, Jaspreet. This was a long time coming. As you know, it's business first. I mean, we tend to put ourselves on the back burner. And like you mentioned, these relationships take time. I talk to business owners every single day from East Coast to West Coast. And they always talk about the same issues that they're having. Communication, they're overpaying their taxes, they're meeting with their accountant after December 31st. And we always say, if you're meeting with your accountant after December 31st, you're too late. Anybody can do bookkeeping or data entry. Like you mentioned, it's all about analyzing and having that proactive relationship. So for me, even if we don't do business together with future clients, I know that will come. And like we mentioned, as long as you're helping people, the money will always follow. The relationships could take a year, could take a day, could take an hour. Like I've been in these scenarios. There's so many times where I've been on the phone and I've talked to the client, and they're not ready yet. They're almost there. And the fact that I say, hey, you're going to be ready at some point. We're going to work together. It's just all about the right timing. And the feedback I get was, look, based off of your approach, based on how personable you are, and that you understand that I may not be ready, that makes me want to do business with you now. And there's been times where I'm like, look, I'm not going anywhere. Like, we're going to be here. We're going to look out for your interest. If your accountant cares, if an advisor cares, that's who you want to be with at the end of the day. Now, how you can follow along the journey, we create, we're just on, I'm on Instagram, and we're working on things on the back end that we will announce publicly. But I want to provide as much free content and value as possible. So even if you follow the Instagram, it's my name, Khalil Dabaja, you follow that Instagram, I guarantee you're going to learn so much about accounting and the tax code that you can benefit from whether we do business or not. But at some point, we will do business when the client is ready. And that's what we seek. We're growing our firm nationally. So if you want to follow along on the journey by following the Instagram and other things that we're going to announce in the future, it would be our honor.
Perfect, man. Well, thank you for your time. It was great having you. If you haven't already, definitely check out Khalil's Instagram page. Whether you're a business owner, employee, there's a ton of free value that he's putting out there. Khalil Dabaja. I'll link it down in the description. I'm going to put it on the screen here for you as well. Thank you for watching, and thank you, man.
Thank you,
It was a great time.
Appreciate it.
This, as you can see, is why financial education is so important. The average person is not going to be able to take advantage of any of these tax breaks because they don't understand how money works. And if you're thinking, well, what am I supposed to do? All I do is work a job. I don't have the ability to go out and buy some real estate as an investment. I don't have the ability to go out and start a business. Well, what you can do is